What if I told you billions of dollars meant to change the world are being misallocated, not because of bad intentions, but because of bad data? Impact investing is exploding. From climate tech to social enterprises, capital is flowing faster than ever. But behind the scenes, there's a silent crisis. Investors can't truly compare impact. One fund claims it improved 1,000 lives. Another says it reduced carbon by 50%. Sounds impressive, right? But here's the problem. Those numbers don't speak the same language. A healthcare project in rural Pakistan and a renewable energy startup in Europe are measured using completely different contexts. Yet investors are expected to compare them as if they're equal. This isn't just inefficient, it's dangerous. Because when impact becomes unclear, trust disappears. And when trust disappears, capital slows down. So the real question is, how do you measure impact without losing its meaning? The answer might not be what you expect. For years, the industry believed the solution was simple: standardize everything, create universal metrics, align with global frameworks, force consistency. And yes, frameworks brought structure, but they also created a dangerous illusion: false comparability. Because impact is not one size fits all. Reducing carbon emissions in a developed economy is not the same as enabling basic energy access in an underserved region. Educating one child in a conflict zone is not equal to scaling digital learning in a wealthy city. When you standardize these outcomes into the same metrics, you don't create clarity, you erase reality. It's like comparing temperatures in Celsius and Fahrenheit without conversion. The numbers exist, but the meaning gets lost. This is the core flaw. Standardization assumes sameness, while impact is fundamentally contextual. And until we address this, more data won't solve the problem. It will only make it harder to see. So, if standardization fails, what's the alternative? Translation. Instead of forcing all impact into one format, we translate differences into comparable meaning. And this is where artificial intelligence becomes powerful. AI doesn't need perfect data. It thrives in complexity. It can analyze structured and unstructured inputs, from financial reports to satellite imagery, and identify patterns humans simply can't. Imagine an AI system that understands context. It knows what 1,000 lives impacted means in a low-income region versus a high-income one. It adjusts for baseline conditions, geography, and access to resources. It creates dynamic benchmarks instead of rigid ones. Suddenly, impact becomes comparable, not because it's identical, but because it's interpreted intelligently. This isn't about replacing human judgment. It's about augmenting it, turning scattered data into meaningful insight. For the first time, investors can see not just numbers, but what those numbers actually mean. But there's a catch. AI is not inherently fair. It reflects the data and the biases it's trained on. Without strong governance, AI could create even bigger problems. Black box scoring systems that no one understands. Hidden biases that favor certain regions or sectors. Impact ratings that look precise but lack accountability. And in a field built on trust, that's a serious risk. Because if investors can't question the system, they won't trust the outcomes. That's why governance must evolve alongside technology. We need transparent models, auditable systems, clear methodologies, and most importantly, input from diverse stakeholders, not just investors. Impact isn't just a financial concept, it's human, and any system measuring it must reflect that. Otherwise, we risk replacing one flawed system with a more sophisticated one that's harder to challenge. The future of impact investing isn't about choosing between data and context. It's about combining both intelligently. AI, guided by strong governance, can unlock a new era where impact is not just measured, but understood. Where investors don't just ask, what are the numbers, but instead ask, what do these numbers truly represent? This shift changes everything. Capital flows more efficiently. High-impact opportunities are no longer overlooked. And credibility, something the industry desperately needs, begins to rebuild. Because in the end, impact investing isn't just about deploying money. It's about creating real, meaningful change in a complex world. And to do that, we don't need simpler systems. We need smarter ones.